What's up, audit fans? Auditing accounts payable is really important for any business. Managing the cash going out, the cash outflow, the cash payments is really critical. Yes, we want to earn revenue and have money come in, but controlling the money that goes out. Make sure that we don't spend on frivolous things like Ferraris or overseas holidays for our executives, but we're spending it on business related goods and services to help us achieve our objective. Today in this video, I'm going to go through the processes related to accounts payable and purchasing. And in part 2, you're going to see the tests of controls and the substantive tests that we're going to use to gather evidence for our audit opinion. So let's get into it. Welcome to Amanda Loves Audit. My name is Amanda. I do love audit, and I teach audit to undergrads at a major Australian university. I've been making videos here on my channel for almost a decade, and I love helping students, those studying for their professional qualifications and those looking to move into the audit industry, to really understand the fundamentals of audit. So today we're looking at accounts payable, and I'm just going to jump right into my tablet. And it's really important when we think about accounts payable to try and consider what are the processes that happen. So I'm going to talk about some of the common steps in an accounts payable process. So the first step is normally going to be some form of purchase request. So we need something, or somebody within the business needs something. There is a process of making a request. After that, there needs to be some sort of approval of requests. And usually there is also some sort of hierarchy. So they have something called either delegated authority, or sometimes it might be called also approval authority, which says that certain people can authorize certain things. So quite often it's based on a dollar value amount. So it might be that person A can approve up to $1,000. Person B might need to approve anything between $1,000 and $10,000. It might need to be that you go, another level higher for somebody who wants to spend a certain amount more. And at universities, for example, if I want to purchase something, I go to my head of department. And if it's less than a certain amount, my head can actually approve. If it's higher than that, but less than another amount, it would have to be my dean or my deputy dean of my faculty. If the university wanted to buy a brand new building, then that would need to go to our equivalent of the board of directors. So there's different levels of authority depending on what we need to approve, how much it is, the purpose of that particular request. So we've got to have approval of our request. Now, it doesn't matter whether it's goods or services here, but there needs to be a process for ordering once we've got an approval. That will often include things like getting quotes, evaluating suppliers, and potentially also having an approved list. That's quite common, the approved list of suppliers. So for example, in New South Wales, the state government has an approved list of suppliers that you can use if you work for a government department, a school, a government agency. So ordering is really important. Now, one of the things that's critical here is also that we have segregation of duties, that we have different people doing different jobs. The person who makes the purchase request is different from the person who does the approval, is different from the person who does the ordering of the item, and then is also separate from the person who receives the goods. All right, so it might be that goods are received at a loading dock or a warehouse. We have sort of like a parcel delivery area at my university where everything goes. And when goods are received, depending on the item, there might need to be some sort of receiving report. It could be a document, it could be electronic, that says we received these items on this date. Now, in some organisations where you're expecting a lot of goods, your receiving report might also be partly what was in the order. So quite often a common thing to see is the order, but with the quantities blacked out, so with the quantities left blank. And that would mean that the person in the warehouse or the receiving dock or the loading dock has to say, oh, yep, we received a whole lot of Apple pencils, and there were 20 of those received. Now, often, why does it have the volume blank or the quantity blank? It's so that the person in the receiving department will actually count them themselves. That's because if I had a whole box of things, rather than count it, I might go, oh yeah, that sort of looks like 56, if I knew that that was the quantity. So usually a receiving report will include the items and the quantity that was received. And again, it could be a person doing it or electronic. Now those reports, typically if they're paper reports, they'll keep a copy in the warehouse, but also they'll need to send a copy to accounting. And I forgot to add up here, once we've had an order, copies of orders should go to our accounting department as well. All right, because remember, they're the ones that have to do all the journal entries here. So we've got purchases, approval, ordering, receiving goods. Then the next step is invoices. All right, and that means that typically people in a business situation, for most of our audit clients, they will receive goods and not have to pay for them till later. So they're buying goods on credit. So it creates accounts payable. So with invoices, we need to understand how often do we get invoices, so what's the frequency? And usually those are sent straight to accounting. All right, so they don't need to go back to the person who ordered it or to the purchasing department or the receiving area. Invoices quite often will get sent straight to accounting. And probably not many people will use paper invoices these days. It's much more likely to be electronic as some sort of PDF. Now, those could also be linked into whatever systems the business uses. So that could be Xero, it could be MYOB, it could be SAP. So you would get some sort of automated process for that invoice from your supplier. So invoices go straight to accounting. Then we have to have process for payment. And this is where it gets a little bit, not more complicated, but there's many more steps here. And this is done by the accounting department. All right, so the accounting department is going to receive 3 pieces of information. They're going to receive information about the order, so they'll receive the purchase order. They're going to receive, now I've written these as documents here, but these could be electronic files. The receiving report, which says what we received, and then they'll also get a copy of the invoice. All right, and typically what will happen here is a process of a 3-way match. So we have a decision process normally here. Oh, that's not a very good diamond. Let me try that again. So we do something called a 3-way match, okay? And so what we're doing is we're feeding all of these documents into this process and we're trying to find out, does it match? So if on the purchase order, I ordered item A and I ordered a quantity of 50, in the receiving report, I should see we received item A. How many did we receive? Oh, we received 45. Well then in the invoice, then I would be expected to be billed for only 45, right? I don't want to pay for 50 if I didn't receive that many. So the 3-way match is about trying to make sure that the goods we ordered are the goods that we received and the goods that we were billed for. And if it's not, so if it doesn't match, so if there's a no, then what we're going to need to do is make some inquiries and follow up. All right, so, we might, let's say we're billed for 50 and we only receive 45. I'm going to call the receiving department or the warehouse and say, what happened? Did we receive all these goods? Are any goods missing? I'll call the supplier and say, well, you billed us for 50, but we only received 45, a 5 on back order, so I need to follow up if it doesn't match. Now, if it does match, if we get a yes, then we can proceed to the process of preparing the payment, all right? So we're going to prepare the payment. Now, preparing the payment usually involves a couple of different things. There's some paperwork, which essentially is what they often call a voucher package, which will contain from up here the purchase order, the receiving report, the invoice, and then a cover sheet that says, yep, we've checked all these things, everything matches off. All right. So it's going to be some paperwork, and typically at the same time as preparing the paperwork, you'll prepare the payment transaction. Now, I'm going to assume that we are not using physical checks anymore, that the payment transaction is going to be EFT, electronic funds transfer. So typically someone will go in, they can set up all the payments, select the right supplier, prepare everything there, and have all of that ready to go. Now, the next step here that needs to be done by somebody different is approval of the payment. Now, to approve the payment, usually what that person does is that they will review this package of information. So the accountant will prepare it. They say, yep, I've done all these things. I've checked everything off. They're going to review it, check, everything matches. They might stamp, they might sign. If it's in the system, they might press a button or add a code. So they're going to review those documents, and then after they've reviewed it, they're going to go in and they're going to look at the bank transfer system and say, all right, I'm going to make the final approval for the payment. Final approval, release, payment. Now, that could happen typically with some sort of security code. Now, there's a good question here as to how many people will do this. Because in the old days of physical checks, it was quite common to have two signatories for checks. Now, of course, if you're watching this from North America, you are used to seeing CHEKS. In British English, we use QES. So quite often it's common to have two signatories to make sure that if there's no collusion, that there's sufficient oversight. So in smaller firms, you might just have one person who approves the payments. All right? But in a larger organization, that approval of payment, that review process might be done by potentially two people. All right? So they both have to check and before the payments can go off. Now, of course, that means that after the payments have been processed, all of this paperwork has to be filed away somewhere so that if we need to go back to it, we can. And after the payments are made, we need to make sure that we have journal entries that have been recorded. All right. And remember, that journal entry is going to be debit accounts payable, credit cash. Now, a good question is probably raised here as to where journal entries happen at other places. So in terms of where we might have journal entries for other items, and it depends on the computer system. So this is why it's really important to make sure that you understand the client, understand their business processes, because when they've made the order. So it could be that when the order is made, that we might have a journal entry that is debit, whatever the item is that you're ordering, credit accounts payable. All right, so it could be when the order is made, but what is more appropriate is typically when you receive the goods, because you don't owe the money until you receive the goods. So what is better or what is preferred is when goods are received, you can go debit inventory, or you could go debit stationery expense, or whatever it might be. And then we'll go credit accounts payable. All right. So this is why it's important that that receiving report goes to accounting so that they can start preparing these sorts of journal entries. So it's a pretty big process in terms of managing accounts payable. And this is really important because we want to make sure that we control the cash outflow really carefully. We don't want cash going to things that we didn't need, the business doesn't need, and non-business expenses. So we've got the purchase, the approval, ordering, receiving the goods, receiving the invoice, processing the payment, which includes the three-way match, the checking of the three-way match, and the electronic funds transfer. Now, I do want to raise here one instance in which you might not use a three-way match. So there is the option for a two-way match. All right. Now, two-way matches typically happen in businesses where there are significant supply chains. All right. So they have an agreement. So you have a company. So let's say that I think it started with Ford Motor Company, and they have lots and lots and lots of suppliers. Okay. And they said, well, we're actually going to try and make the process easier. And rather than having a three-way match, I'm only going to have a two-way match. So in a two-way match, usually there'll be a process for an order. There'll be something to confirm receipt of goods. And then once you have the two of those, if they match, then you can process the payment. Now, how can you process the payment for something like this when you don't know how much? Well, that's typically because the suppliers all have dedicated contracts that tell you about prices for things, and the prices are governed by those contracts. So if I ordered, 2 widgets and my contract says that widgets are $50 each, as soon as I receive the 2, then I've got a match, and then I'm going to send them payment for $100 automatically. So where you have really strong supply chains, so a business has lots of particular suppliers they use, or if you're one of these suppliers as part of their accounts payable process, then there is the opportunity for two-way match for accounts payable for companies like Ford that have lots of contracts, and business is pretty standard. Now, of course, if there's like a non-standard purchase, something outside of one of those contracts, then they are probably going to need to go back to this three-way match process. Whew, so that's all of the processes related to accounts payable and purchasing. In my next video, what I'm going to do is I'm going to go through how we will test the internal controls and gather substantive evidence to make sure that payments and accounts payable meet our assertions. So thanks for watching. If you thought the video was useful, I'd really appreciate a thumbs up. Consider subscribing and stay safe, stay well, and I'll see you next time.